Taking a step back, the way we've always thought about it is if we build a business that has great return on equity in the long term, which is basically profit divided by how much equity capital are we using in the business, we'll be fine. The cult of personality at some point I think gets everybody down. Little did I know that the job was working in one of the most happening gay bars in Chicago, and that we were going to live 6 Irish guys in a 2-bedroom apartment directly above us.
Hello everyone and welcome to Fintech Leaders, coming to you from New York City. I'm your host, Miguel Armaza, and I'm a co-founder of Khosla Ventures, a venture capital fund that backs early-stage fintech entrepreneurs. If you enjoyed this conversation, I invite you to leave a review on Apple or Spotify so more people can learn about fintech leaders. In this episode, I head to downtown Manhattan to chat with Daragh Murphy, CEO and co-founder of Imprint, a fast-growing and leading fintech in the co-branded credit card space that has raised about $200 million from Thrive Capital, Ribbit, Khosla Ventures, Kleiner Perkins, Stripe, and many more great investors. In this episode, we discuss challenges and lessons in building Imprint, including pivoting and finding product market fit, why delivering return on equity is what really matters when building a company, how they use heuristics to find values-aligned talent at Imprint, a cautionary tale on the fragility of life and a reminder to live fully, and a lot more. Daragh, welcome to Fintech Leaders. I'm really honored that we're doing this just downtown New York, Imprint's HQ. How's it going today?
Everything's great. HQ for now. We're moving.
So I hear. Daragh, there's nothing like a personal story to get started.
Right.
Let's hear a little bit about your story from the outskirts of Dublin all the way to Wall Street.
Yeah, for sure. So I grew up, there's a place called Kildare, which is about 30 miles from Dublin, and very normal, really happy family. I had a crazy Irish grandmother though, and I have to tell Jewish friends of mine in America that Irish grandmothers are like Jewish grandmothers. The trope being that if you do well in school, you should go and become either a doctor or a lawyer. And I hated blood, and so my crazy Irish grandmother really wanted the lawyer in the family. And so I ended up going to undergrad law school in Ireland for 3 years, had a great time, made a bunch of friends, and then got a job offer for a big firm in Dublin. And it was the bottom of the financial crisis. And it was so grim in Ireland. There'd been a massive bailout. At one point, the country was going to go bust. And a friend of mine moved to the US for school and said, hey, come over for a summer. I'll get you a job. It's a rite of passage for kids in Ireland to get this J1 visa that I think only we can get, which is really cool. And I came to Chicago for a summer. Little did I know that the job was working in one of the most happening gay bars in Chicago, and that we were going to live 6 Irish guys in a 2-bedroom apartment above it, like directly above it. So
and working downstairs.
I'm working downstairs. And so like you would get finished with work and go upstairs, and we couldn't afford any furniture. We had plastic tables. The ones, actually my in-laws are Bills fans. You see them jumping through them sometimes, maybe not my in-laws, but definitely the neighbors. Those types of plastic tables. We had these red Solo cups that I'd only ever seen in movies, and you'd put them on the table, and the trance music through the floor would basically have the cup like vibrate away from you. And so that was my introduction to America. And, you know, it was sunny, it was Chicago, we had the best summer ever, made a bunch of money, and I just couldn't go back. And so I ended up staying, extending my visa, and getting a job at a small law firm, worked the law firm for a year, went at Duke after that because I wanted to stay in and maybe get a job at a big law firm. Ended up practicing law for 3 years and didn't love it. Moved to McKinsey for 3 years, which was great. Got a green card. 2 days later, I left McKinsey, spent a small amount of time at WeWork, and then left that and then started Imprint. So that's the biography here.
Was your grandma pretty intense?
I was always the favorite, and so I was made fun of a lot by the other grandkids because she definitely played favorites, and it was a badge of honor that I definitely wanted to keep more than anything else, I think.
Very cool. You mentioned a short stint at WeWork.
Yeah.
Was this during the restructuring?
Well, actually, right before. So
Right
I mean,
before.
like 11 months up to the failed IPO.
Yeah.
A woman who'd taken a bet on me when I was very young at the law firm, actually giving me my first job at a big law firm. I'd become the general counsel and COO there, and I just couldn't wait to get out of McKinsey. And was talking to her. She said, "Hey, come, a lot of fun." For 11 or 12 months, it was a lot of fun. But people ran through walls. And so you could see that if you could, my takeaway was if you could get people who were aligned on doing something and have similar values, the sum of the parts, or the sum of the whole would be so much more than the sum of the parts. And we work as a physical business that compounded 100% or more every year. I think the year I left, it had $4.5 billion of revenue. But you deliver that revenue by building office space, which is really hard. Growing that quickly in any business is hard. And I think the part of the reason they could do it, obviously there was a lot of capital, but on the human side, it was because so many people bought into this singular vision. That was really interesting learning for me.
Yeah. Do you think just in general, do you think you can build that type of fanaticism or maybe focus to run through walls without the cult of personality?
It's something I think about a lot. And I certainly think, I hope you can, because the cult of personality at some point I think lets everybody down. The Wizard of Oz is a great parable about this. I just watched Wicked last weekend with my wife, and that's probably why it's top of mind. My perspective would be, and our perspective here is, nobody stays at Imprint because of Daragh. Rather, people come because they believe we can build something really big, and knock on wood, we're well on the path to that. And they get to work with a tribe of people who match their values. I actually often get reprimanded by our leadership team for saying this, but we always look for people who are on one vector really talented, and on the other vector super values aligned. And so it's not just good enough to find people who are really talented. We want to find people who are values aligned, and we use heuristics, as most humans do, in trying to find those people. And what we often find is you're an immigrant, you're the child of an immigrant, or you grew up in rural Ohio or West Virginia and then went to a good school. And those people, they seem to have their heuristics, that the values they share are, they have a high tolerance for uncertainty. They have tons of pride in their work. They really value moving the ball down the field. They have maybe not low ego, because they're probably prideful in how good they are, but they have very low entitlements. And what we've always said is if we can find those people, then we are creating a version of the cult that's not a cult of personality, it's a cult of people who are incredibly aligned. And what we found is that as long as we focus on that, the other things are good, right? Like, we don't spend time talking about diversity here, but we've done the benchmarking, like we even have perfect diversity, which is awesome, even that we're a fintech, and that's a really hard place to do that. And so we're hoping, let's see how the experiment plays out, that you can build your own version. Cult might be a dirty word, but of these super values aligned people with one mission.
Yeah. You mentioned either an immigrant, sons of immigrants. The person who grew up in rural Ohio and is working in New York, I didn't think about this before, but it's also an immigrant.
Totally.
Think about it, right?
Totally.
We find something very similar in our portfolio
Yeah.
of Gilgamesh Ventures, our New York founders or US founders, even the ones outside of the US, they tend to be very similar profiles. So sort of mobility, immigration, something that has put them a little bit of a chip on their shoulder.
And I fundamentally think you can be double Harvard and have those values,
Absolutely.
right? And we're just looking for people with those values. Yes. The background is more of a heuristic rather than a limiting factor.
Absolutely. I rarely ask this question, but you seem like a very focused guy. How does your morning look like? Do you have any routines?
I often joke with our team that I'm probably the least structured person in my personal life, and so I try to impose structure so that I don't spin out, because I often think that if I'm not structured and on time, it just has an awful knock-on effect. So the one thing I'll do is I just wake up and work out. Right. So I have a friend who works out with me, holds me to account, and every morning at like 6:30, I'm gonna get up and work out, and that then sets a nice like cadence for the day. Come home, walk the dog, do the email, spend some time with my wife, and then come to the office. And then generally that's a nice starting point. One thing I've started to do less of is kind of the music or the podcasts first thing in the morning. I'm addicted to podcasts, not to plug the line of business, but I find in the mornings, if I can not just like pop something in straight away, it's very helpful. And there's this thing of sometimes you're in the shower and you get that like random thought. I find that if I walk into to meet my buddy to work out, I can get that as well, as long as I don't have, the constant distraction.
Yeah. Always the same workout?
I'll mix it up. Yeah. So, any favorite sports? Rugby was the sport I grew up playing. Gaelic football. My younger brother was really good at it, so I ended up playing rugby. He was always going to outshine me on the Gaelic football pitch, and more like the NFL.
And how about internally at the company, right? Do you have a way of structuring your week or your days? How do you manage your account?
We steal a ton of ideas from other places, right? I think, and one of the things that we try to, I probably goes to like not being a pilot or having a low ego. Like we believe there's tons of people who've figured it out before, and we try to steal pretty heavily from companies like Amazon. And so we run our week a little like how we understand they run theirs. Actually, YL, who runs product and technology here, grew up at Amazon, built Amazon Pay, so he's brought a lot of that over. So our week is Monday, it's kind of meeting light would be the way to think about it. People have work to do. Tuesday, we have what we think of as our weekly business review. And really, there's like 3 questions we're asking in that meeting. And that has called the top 24, 25 people at the company. That's what are the customer cardholder experience last week? What are the input levers that are going to change the business, and how are they trending? And are we heading towards the financial plan or targets we set for ourselves? And then in the meeting, we have 100 different metrics that are automatically being pulled into a dashboard. And we're basically looking at, is that metric okay, or do we need to stop and talk about it? And over time, then obviously we're refining what the metrics are. And hopefully everyone at the leadership table is building this kind of intuition for, customer call wait time went up by half a minute last week. That's something we need to just double click on. And we won't double click on it in the meeting. Normally we'll have the person follow up with a Slack message to the group so we don't continue to schedule time. Or once a month we have functional operating meetings where we'll deep dive on anything that might be off. And so the week then kind of cascades out of that. We'll have a smaller leadership group meeting on a Wednesday, and then every second week on a Thursday, we'll have an all company. And that's kind of how the week is structured. And that brings a ton of clarity about, are we on track, off track? Are we focused on the right inputs? And then just try to leave a bunch of space for people to do their work. Like trying to not have people in meetings doing reporting up as much as possible, automating away, having to go gather data, really try to not have people make PowerPoint to Imprint or slides. Just find it takes a long time and it masks all the underlying interesting information. So for those operating meetings we ask people to come with 10 bullets and let's review the dashboards that are off, rather than you having to spend a day and a half prepping, etc.
So some of this, did you have to unlearn some of this from your McKinsey life?
No. I think the interesting thing about coming out of McKinsey is that in some ways it makes you an amazing communicator, and in some ways it makes you an awful communicator. And I've had to figure out what that dual modality is. And so, building fundraising decks or board decks, I would say, is an amazing skill set that a place like McKinsey gives you, how to structure it, how to think in the pyramid principle and communicate that way. But when it comes to there's something broken at the company, or we've got to undertake 6 weeks to fix something or upgrade something, which is always true given the rate we're growing at, I find that having somebody write down a 2-page memo and a couple of graphs is a way better conversation starter. And so it's just about picking and choosing. I think is the learning I've had.
Yeah. I mean, to be fair, it comes down to the individual a lot of times. There's a long list of
ex-McKinsey or for that matter, McKinsey for sure, who have built up huge companies.
Totally. And I think the great thing about a place like McKinsey or Bain is if you stop there for 2 or 3 years, you will be one of the better communicators you've ever met, just because the workforce that upon you, a lot of people are scared who have liberal arts degrees or didn't study math, and they'll say, I'm not good at math. It's reality, like basic arithmetic and why you do a spreadsheet isn't that difficult. And you could have a liberal arts background and learn the basics of both communicating and how to do basic analysis at a place like a consulting firm. And that is a tailwind for the rest of your career.
Daragh, for how long were you marinating on the Imprint idea? Because for people who don't know your story, they might think from WeWork to Fintech, how did that happen?
Totally, great question. So when I was at McKinsey, I was in the financial institutions group for a long time, primarily served banks, a lot of credit card banks, doing really boring stuff around regulatory issues, but more and more than graduating to work on how do we go acquire credit card holders. And the two things that were really interesting to me were the banks I worked with that had a co-branded credit card portfolio. They would think about the problems all wrong. They would think, what's the most important to the bank first? What's most important to the brand they're working with second? And let's think about the cardholder third. So that could be like bank first, JCPenney second, or Macy second, cardholder third. And to me, that was all wrong. Like it should be cardholder, partner, bank, or issuer. And then the second thing was you would talk to these executives who had really good ideas or wanted to build a better credit card experience. The Apple Card has just come out. They're saying, how come we can't do that? And the reason always was, we don't control our technology stack. And so most people don't realize that the credit cards in their wallet, when they get swiped, it's not the bank that does the back-end processing, all the actual, let's say, information technology processing, the creating a data entry in a virtual ledger happens at a third party that the banks don't control. They license all their technology stack effectively. And that was like a really interesting insight. And I kind of forgot about it, to be super open. And I started working on a startup idea after WeWork that kind of caught the bug. It was around fintech, but it wasn't squarely in the co-branded credit card zone. I got to meet the guys at Thrive Capital. In fact, I was connected with them when I was sitting on my in-laws' couch in the pandemic, eating Cheerios and watching NBC as if I was going to learn anything. And I was like, I'm going to pitch them on my startup idea. That's really interesting. I've been thinking a lot about co-branded credit. What do you think about that space? And then my co-founder, Borat, used to be a partner at Thrive, and I basically spent 5 months of the pandemic really refining it. I was like, I'm going to build the deck and go and try and sell it. Let's see what customers think. Let's understand if it's viable. And that was really the marinating period before we started the company in August 2020.
The part I'm interested in, what you just mentioned, is let's see what customers think.
Yeah.
Who were the first potential customers that you talked to, and how did you approach kind of selling this vision?
For sure. I think when you want to go build a business, we want to do a startup, there's so much noise out there. There's a ton of books you can read, and you can listen to founders on podcasts. I think Y Combinator gets it right, as if that's not going to be a truism, but Y Combinator gets it right when they say build something that people want. And so for us, it was, if we went and talked to 15 people who have co-brand relationships already and have a program or could have a program and take their temperature, like what are the common pain points, right? And it was very clear after the first 3 or 4 calls, what they were all complaining about was banks are slow, they don't build modern technology, they don't treat us or our customers well. We wish those were different. And then suddenly, like, okay, let's hire a designer on the side and build a deck as if this exists. And the fourth call goes if we actually pitch it back to them, right? And that was really the kind of like test and learn phase to say, okay, there's the pain points. Let's build on a deck what looks like a company, and then rapidly kind of run through those conversations. And so we were having conversations with companies like StockX, Glossier, Skims. We spoke to DoorDash at a certain point in time, just trying to get any introduction possible through our network. And we actually got it wrong. Like when we raised our seed round, we had kind of made this mental decision. Yes, in the future, we can go after the DoorDashes of the world or the Creek Barrels of the world. But today we're going to start with the e-com brands because e-com brands will be easier. So we're going to go after Glossier and Skims. And what we found after like 6 months of starting the business, trying to sell to them, they just weren't interested. And what happened was we got inbound from our big partner HEB, and we actually very quickly had product market fit at enterprise in a way we never had at almost enterprise. And so we were just fortunate, I think, that trying to find product market fit is hard, but we were fortunate that as we continue to try and sell it, somebody finally took notice of us.
Am I correct that one of the tensions that you will have in your business is the rate of approval, right? Maybe the business wants older customers to get approved.
Yeah.
You can't approve everyone because it's credit.
Yeah.
Am I right in that?
So in the sales process, it generally comes up if you don't already have a co-brand program. And the potential partner who wants to launch a program will have somebody around the table have the same concern. And I actually don't have my wallet on me, but normally the first thing they'll say is, here is the piece of plastic or the piece of metal, and we show it to them and we say, where does it say Imprint on that? And they'll say it doesn't, and we'll say it says your brand. And so, of course, you worry then that we're going to, use an Irish phrase, piss off your customers. But what's worse than us pissing off your customers by saying no to them on the credit piece is us having to go and do collections and hurting their credit score and calling them. And that's part of credit, right? Is with the money away, you have to collect on it. And so when we have that conversation, it very quickly flips. And most US consumers who are not going to get approved know that there's a high likelihood they're not going to get approved. And so it's much better to say no up front than to potentially ruin somebody's life. That might be an aggressive frame in the sales conversation. And as soon as you have that conversation, people say, actually, I get it, right? And there's so many brands now, Apple, right? Very inclusive, tries to treat all its consumers the same, and they have a credit card, right? And so if Apple can get there and Disney can get there, these hyper customer-centric brands can get there, we find that you can explain away the tension. But on its surface and on the face of it, definitely feels like something to be wary of. And then it is something you should be wary of, because programs that aren't doing well, what happens is the issuer or the bank starts to really close down approval, and that's not a good outcome either. And so we always think about the partnership as like a marriage, and our job is to have a healthy relationship. Yeah. And if we're back looking at what the contract said, that's like, let's go look at the prenup, but that's a terrible outcome.
Yeah, I forgot to pay, one month my Macy's card, right? And I wasn't angry at Amex. I think they're the ones.
No, it's not Amex. It's a bank you've never heard of.
Yeah. So I don't even know, but I was angry at Macy's, of course, right? So and like I'm a fintech insider, so I know exactly what you're talking about.
And we've actually always tried to lean in on that point too, right? Because so many people have the experience themselves or a family member who got in that instance, the private label credit card. It doesn't work anywhere else. It has lower utility, but got that card and forgot about it. And we always say we really want to avoid that, because if we can be open and honest and transparent with the end customer, they're much more likely to use the card and much more likely to be loyal to the brand. So if you look at some of the old school banks, they make between 25 and 50% of their bottom line from late fees and penalty fees and missed payment fees. We make about 3 to 4%. And that's because we tried to make the app easier to use, be transparent, over notify when the customer's bill might be due. For some of our programs, we want to avoid you having a foot fault. So if you miss one payment, we'll waive the late fee, because we want for you as a customer to have a trust with the brand, and then for the brand to have trust with us. And that should grow a bigger pie. We might make less, but the pie is bigger, so we'll make more in the long run.
I mean, I'm sure you might have heard this from David Belez of Nubank. I think he said this in an interview with me, maybe it was a different one, but he was talking about how there was 1 month early in the life of Nubank, they saw a spike in revenue. Like, what's going on? And they realized their automated verification had not gone out to warn a bunch of users about their due date. And he talks about how that was a really defining moment, what kind of company do they want to be? Totally. Because they'll need more money.
Yeah.
Right. But then they decided to always send that notification.
And this is like the Costco thing, right? Where like Costco really tries not to take the membership fee up or these other prices up on the customer, because if they do it once, then it becomes this sick addiction, right? And for us, it's the same conversation all the time, right? And our just long-term belief is there's a massive company we're building here, and more brands win because they care about customers. And if they have to choose a partner, they will continue to choose us because we care about them and their customers. Yeah.
And so in terms of managing a credit portfolio, I think this is a topic for a lot of people interested in fintech. A lot of VCs don't want to invest in credit businesses. There are many examples of credit business thriving.
Yeah.
How did you approach this to build a healthy portfolio from zero?
I would say that actually, thanks to David Velez, a lot of people have changed their tune on credit businesses, right? Like one of the biggest, most successful fintechs in the public markets, right? Them and Chien.
Absolutely.
Obviously, Max and Affirm, similar story. So we get to stand on their shoulders. It's not like where we really saw, I think, got to invent the asset class. Kind of taking a step back, the way we've always thought about it is if we build a business that has great return on equity in the long term, which is basically profit divided by how much equity capital are we using in the business, we'll be fine. And if you can pretend a bunch of different things about your business. Talk about WeWork, you can pretend that space as a service is not real estate. You'll eventually be found out in the public markets. And so our view has always been, let's build a great business model that has great return on equity and high growth and is a tech company as well as a financial services company, and everything else will take care of itself. And if that's true, it makes decisions around what are you going to do around the loan book, credit, do you take it off balance sheet, on balance sheet, makes it really simple because you're not optimizing for those things. You're optimizing for how am I going to build a great long-term business? And all of these things are levers along the way, right? So a good example is like, should we have the credit and the debt on balance sheet or off balance sheet? We decided to be on balance sheet because it gives us more long-term control. We're never in a position where the market shifts and we suddenly can't fund loans. And if that happens, we suddenly have to decline customers who are applying and also stop having card swipe, even though that will be asset light. That feels like a much worse trade-off. Again, we'll have a great outcome with high ROE, regardless of whether we're balance sheet light or not. Another example would be, should you be a bank or not be a bank? We don't think about becoming a bank as a destination. It's a way for you to have a lower cost of capital over time, right? And so to go back to the start, how we funded Imprint, we do what a lot of the fintechs do, right? And Square Block has done this, Affirm has done this, does this. We fund ourselves on the loans on each card using today warehouses. We have about $800 billion in warehouse capacity, which has been great. And we're starting a securitization program on top of that, right? So funding ourselves like the banks. And the nice thing for us has been a lot of times when we had early conversations about Imprint with the VCs who would invest in a credit business, the conversation was around, well, your cost of capital, you have a massive disadvantage on cost of capital versus the banks, which obviously was true at the start. At one point, we were funding ourselves at SOFR, which is the funding rate, plus 1,200, right? So SOFR plus 12%. And banks fund themselves at something between SOFR plus 50 and SOFR plus 150. Today, we're funding ourselves at SOFR plus 250. And the reason we would do that is because we kept the loan book really healthy. We've been really thoughtful about having the right team in credit, right? Machine learning, AI is all really helpful. It's about having a talented team and listening to them, first of all. And then we've been really thoughtful about what's the asset class, right? So we have stayed away from subprime. Weighted average FICO in our loan book is about 705. So a prime credit card portfolio. And it's kind of dawned upon us that we're N of one in the credit space because we're the only fintech that has issued prime US credit card receivables at scale. And because of that, there's a lot of appetite, right? Good track record, good risk team. And these assets that people really want to fund has helped us on cost of capital. So it turned out to be the right decision for a bunch of reasons. But I think for us, that first principles approach of build a great company, focus on really good ROE over the long haul, and everything else will follow.
You mentioned your investors a couple of times. what is your relationship like with your VCs?
Yep.
Has it evolved since the C to both Series C now?
Yeah, we've been very fortunate that the investors we've had, I think I've actually been personally very fortunate. The investors we've had have given me the space to grow, because you look back today on the version of the person I was in the role 4.5 years ago, you kind of walking around telling everyone I'm CEO, but you've never done this before. And you have these world-class investors, Thrive, obviously one of our biggest backers through the long haul, and they're backing Sam Altman and OpenAI. And before that, the Slack founders, the Instagram founders, and the Stripe founders. I think I was very lucky that I made a ton of mistakes, and these folks weren't saying, why'd you mess it up? They were encouraging me along the way. And that's been true of Kleiner Perkins, who Mamoon, who led our A, again, like one of the best investors in the Valley. And again, has given me the space to figure it out. And I think that's the thing I've been luckiest about, is I've had investors who have a long-term orientation and who have been humble and kind enough to give me the space along the way to figure it out, right? And then as we've grown up, we've added folks like Ribbit to the cap table. And that's been amazing, because boy, do they understand credit assistance.
And about the mistakes, could you share a couple of those that have been really consequential?
I mean, I'm sure we make mistakes every day, right? And I hope that will continue to happen, because it'll mean you're progressing and growing and traversing new ground. Let's see some of the big ones. We didn't have product market fit, and we joke about it, kind of like the 13-year-old who just gets to high school and everybody else has dyed their hair pink, and we're sitting there saying, fast and bold of these cool businesses in fintech, we're going to dye our hair pink and pursue that. And for like 4.5 months, we were like not a credit card business anymore, which is crazy, because we built all this infrastructure and we just didn't realize that the sales cycles where we have product market fit were going to take a long time, right? And so today it's great because we have all this visibility into how next year is going to be. Back then it was incredibly scary, but you don't have self-assurance, you just waste time, right? And so I'm incredibly impatient, and I think about where we will be 5 months from now. I'm still upset with myself that we lost those 5 or 6 months, right? And so that's truly my decision. There's been small things that are become really difficult over time. Like when we raised our Series A, there was a bunch of small investors who wanted to get involved, and I was feeling charitable or didn't know what I was doing, and gave a bunch of people pro rata rights, thinking like, oh, it'll be fine in the future. But then in the future, when you're raising money and we have big investors who want to fill out the round and you're doing well, suddenly a round that's going to be 30 million from a new investor, 20 from existing, you have 50 million of people who have the right to put their money up. And you're in a position where the people who put the most money up are going around to cut themselves back for these, I wouldn't call them freeloaders. These have been great investors of ours, but small things like that. And these people have had patience because it comes up every round ever since. And you can imagine them sitting there rolling their eyes saying, here we go again.
Yeah. Good lessons for founders.
Totally.
And in general, what aspects of fintech have you excited these days? The reason I ask is you mentioned Ribbit earlier this year. They had, maybe you were there, but they had an interesting presentation for some founders asking themselves, oh, is fintech dead?
Yeah.
And they have a really interesting take.
Yeah.
Shalik is coming on the podcast soon.
Awesome.
But you're in a good position, but you get to see a lot of what's bubbling up.
I think fintech is just incredibly difficult, right? And so like the stuff that's very easy for people to see who are not in fintech or new to fintech has all been tried and done, right? Like everybody has a deposit account and even co-branded credit or BNPL. A lot of the consumer stuff is kind of, I wouldn't say spent, but it's been tried. And I think the really interesting stuff in the US will be not consumer focused, right? It'll be how do we help? I think AI is really interesting for compliance tasks, right? Let's listen to every call. Like, let's not just sample customer support calls. Let's listen to every call and figure out ones that there might be a problem in, and then go to the regulators and self-report. And suddenly you should be getting an A on every exam, right? I think like there's some really interesting companies to be built there and sold to companies like Imprint who have more and more regulation to worry about every day, and sold to the big banks. And so that's the type of stuff that has me excited. And previously felt incredibly mundane, probably, especially if you're new to fintech. these are massive expense line items for some of the biggest businesses on earth. And so what gets me excited about fintech in the future is solving those problems. And hopefully the net outcome of it is just consumers are harmed less, right? And they have a better, easier experience. I think across the rest of the world, there's just so many interesting things. Nick Schubert, who's partner in McShaylick, is starting his own fund, and is interested in investing in new stuff across the world. And I think that's really the most interesting parts of consumer fintech will be who is the Square Cash App of Egypt, who is the next Brett's of Singapore. That kind of thing.
Yeah. Nick, you're definitely a good friend as a Gilgamesh Ventures.
Amazing.
Brilliant guy. So, Daragh, before I let you go, I don't know, are you a reader, or I hear you listen to a lot of podcasts?
Yeah.
Any books or podcasts you want to recommend, present company excluded?
I mean, it's the greatest podcast I've ever been on. The one there's two books that I really always think about. One is for like building the business is Bill Walsh, Score Takes Care of Itself, where he talks about building the San Francisco 49ers, and stuff that resonates when you read his book is stuff you probably hear Bill Belichick have talked about, just about what's your standard of excellence, how do you have people get aligned to these values, get a mission and a vision. And it's really interesting to read it from his perspective on a football team. And I think there's a lot to learn in building a business from it. I'm not the first person to say this, by the way. There's just tons of people who love this book. And then on a non-business oriented side, When Breath Becomes Air is probably my favorite book. It's about a guy who works his ass off to get to the top of the medical sphere. I think he becomes a famous surgeon at Stanford and suddenly gets a terminal cancer diagnosis. And so the first half of the book is the build up to that. The second half of the book is him dealing with that all the way through, his wife writing the epilogue after he's passed away. And my mom passed away from cancer. I read it before and after, and it's such a beautiful book. I also think it's like a really interesting cautionary tale to all of us founders out there who work their ass off trying to get to some mountaintop. And if you don't figure out how to enjoy the day to day, you never know what's going to happen.
Thanks for sharing that.
Yeah, for sure.
Well, Daragh, amazing way to end this podcast. Thank you for opening your doors.
Yeah, sure.
Imprint the office for now. Maybe you're going somewhere else. And yeah, congrats on everything you've done. It's not easy, but you guys make it look easy.
Awesome.
Thank you, man. Thanks for tuning in. I hope you enjoyed this great episode with Daragh, CEO of Imprint. If you want more interviews, make sure to subscribe, follow, and leave a review on Apple, Spotify, or wherever you get your shows. It helps and means a lot. And if you have any suggestions or thoughts about the show, just drop me a line on Twitter or LinkedIn. Signing off, till next week, I'm your host, Miguel Armaza.
The Fintech Leaders podcast is for informational purposes only and should not be considered financial or investment advice.